right, everyone, welcome back to Money Show's Virtual Expo. We are pleased to welcome Avi Gilbert, founder of ElliottWaveTrader.net. He's a market analyst and author of ElliottWaveTrader.net, a live trading room featuring analysis by him and a dynamic community of professional traders. Mr. Gilbert's Elliott Wave analysis appears frequently on sites such as TheStreet.com, MarketWatch, Forbes, and Seeking Alpha. He is joined today by Ryan Wilday, analyst, cryptocurrency trading service at ElliottWaveTrader.net, and also joined by Garrett Patton, senior analyst, U.S. equities and U.S. and world indices. Avi, Garrett, Ryan, thank you so much for being here. It's all yours.
Thank you so much for having us. Okay, ladies and gentlemen, thank you for joining us. Just to give you a quick rundown of how we intend to progress this evening, I'm going to spend hopefully about no more than 10 minutes or so giving you a very quick primer into how Elliott Wave analysis works. Then once I give you a quick primer, I'll take you into where I believe we are in the larger degree structure of the S&P 500. I will then hand it off to Garrett, who will show you some various indices and some of the larger cap stocks that most of you trade or invest in, to give us more support as to where we are in the market overall. And then we'll then hand it off to Ryan, who will tell us where he sees the cryptocurrency market. And hopefully we'll have enough time for maybe about 10 minutes or so of questions at the end. So feel free to hold on to your questions at the end and keep it focused on what we're doing. We're not answering extraneous questions at this point in time. So let me get started, ladies and gentlemen. Again, thank you for coming. Back in the 1930s, a gentleman named Ralph Nelson Elliott discovered that the market was generally what we would call fractal in nature. What does that mean? It means it's variably self-similar. The market moves in a pattern which is variably self-similar at all degrees of trend. Now, what does that mean? Well, what Elliott discovered was that the market moved in 5 waves in the primary trend and 3 waves in a corrective trend. Right here in front of you, I have a 5-wave trend, and you see Roman numeral waves 1, 2, 3, 4, and 5. Now, when I say it's variably self-similar at all degrees of trend, it means if you go into lower degrees of trend, you will see the exact same general fractal. So within the 5-wave structure, wave 1, 3, and 5 move with the trend, and waves 2 and 4 move contra trend. If you take apart waves 1, 3, and 5 within the trend, you would see that they each break down further into being 5-wave structures, and we highlight that within wave 3. If you look at wave 3, you see it also breaks down into waves 1, 2, 3, 4, 5, and it presents the same type of structure, the same 5-wave structure. And if we went into wave 1 of wave 3, you would see the same thing, and wave 3, and so on and so forth. So as you move through the degrees, they all are variably self-similar, no matter which degree of trend you're identifying. Now, Elliott also tied this to Fibonacci mathematics to be able to identify how far a move is going to go from a probabilistic perspective, or how far a retracement is going to take us from a probabilistic perspective. So let's move into where I believe we are in the bigger picture. And we have here, this is a chart that Garrett did for us. It is a 100+ year chart of the S&P 500, as you can see. Now, what is very interesting about the chart is I'm going to show you a 5-wave structure on the larger degree. Wave 1 topped out back in 1929, and we're looking now at Roman numeral paren 1 on the left side of the chart. It topped out at 1929, and we got the crash of 1929. That crash of 1929, which lasted, I believe, about 2 years. I think we bottomed in 1931. That crash was our wave 2. So here we have paren wave 1, paren wave 2. So what should we be looking for? Well, we're looking for another larger degree 5-wave structure that gives us the top to paren 3. If you look all the way up here, you'll see all the way to the top of the chart, you see we have paren 3 up there. And if you look closely throughout the chart, you will see how we have counted that coming top to wave 3 with 5-wave structures. Now, if you look at let's utilize a time frame we're all familiar with. And if you look at the 2000 to 2009 consolidation we have right in the middle of the chart, you will see there is a Roman numeral wave 3 top to that and a Roman numeral wave 4 bottom to that. That 2000 to 2009 time frame was actually a larger degree 4th wave that now led us to expect a 5th wave higher to complete Roman numeral 3 in parenthesis. And we have struck that high, or there's still potential that we have one more higher high to go. But there's one thing I want you to understand. This structure is culminating a very, very long-term 3rd wave, which began, like I said, around the times of the Great Depression. In fact, it was during the Great Depression that Elliott himself, I think it was in 1942, called for a multi-decade bull market. And I believe he was calling for about a 70 or 80-year bull market. Now, when you consider the time frame, it was in the middle of the Great Depression and World War II was raging around him. And he had the chutzpah to be able to call for a 70 or 80-year bull market in the middle of that. In my opinion, that was one of the best market calls of all time. But we are now coming to the culmination of that pattern as we speak. And once we complete that wave 3, we said there's a corrective structure for wave 4. And as you could see, we have that in Roman numeral wave 4 in parentheses as well. That potentially can take, my guesstimate is a minimum of 13 years, but I think it could last as long as 21 years. But I'm not going to go into the details of why I think it's going to take that long, but I'm just going to go into that's the expectation as of now. I'm trying to move through this as quickly as possible. Now I'm going to move into the monthly chart. When I showed my monthly chart, and when I showed you the wave, that 4th wave consolidation from 2000 to 2009, that ended here. And now we're trying to complete a 5-wave structure off there to complete the larger degree paren wave 3. Now, I know I have this listed here as having topped already, but I will tell you this final structure, before I even get to that, let me just show you. We have waves 1, 2, 3, 4, 5. That ends this last move off the 2009 low. And as you can see, within wave 3, we also have 1, 2, 3, 4, 5. I mean, everything breaks down into 5-wave structures. So the problem I have with being very certain that the top is already in place is that I can't count this as a high probability 5-wave structure. Rather, at least one more higher high is what I would like to see to give me a full 5 waves off there. So whether the market topped at the end of 2021 or whether we are going to get one more higher high over the next year or two is really what we're trying to determine. And we'll probably have a much better idea as we move into early 2023, and how the market develops into early 2023 is going to give us that indication. My main feeling is that we will get a higher high, but I need proof off the recent lows to tell me that's the case. What do I need to see? I need to see a good 5-wave structure off the low. And let me show you what I'm talking about to give me a much higher probability. And I know there's a lot going on in this chart. Some of you are not familiar with Elliott wave analysis, but I'm going to explain in as simple a potential as possible. We can now count a possible 5 waves off the low. This only happened today, folks. So I didn't have the time to really change my my labeling. But this gives the bulls a much better chance at being able to get to a market higher high. And assuming if we can get over the next few months, we get a nice consolidation in here that completes a wave 2 pullback, followed by another 1, 2, and then a breakout. To me, this is going to point us towards the 5,000 plus region at that point. So I'm waiting to see how this takes shape over the next couple months in order to determine if we can get that higher high. If we don't get this type of setup, then my fear is that, we still will be going higher. We're going to go back into our major resistance region before we continue lower. But assuming we don't get the more bullish setup, I still think we're going up towards, we said a minimum of 4,100, but I think there's a very, very good chance we can get to 4,300 to 4,600 before we see the next major decline phase. So how the market develops over the next couple of months is going to tell us, do we get that higher high over 5,000, or are we just going to go up to 4,300, 4,600, and then we top out there, and then the market just continues to head lower from there and begin and really effectively confirm and begin we're involved in a very long-term bear market. Now, minimally, I'm going to show you before I hand it over to Garrett, minimally, I'm expecting at least a 5 to 8 year bear market. And why do I say at least? Because I have an alternative potential where this 5-wave rally off the low may only be the first wave in a very extended 5th wave higher high, which means that the first ABC we get off the highs is going to be a wave 2 with a 1-2 setup. If the only way we'll know if that's the case is we're probably going to be buying this low for probably what will be a multi-year rally off that low. If this rally takes shape as a 5-wave structure, then I adopt this, the darker green count, and I'm looking for another 1-2, and then we begin another probably 15+ year rally from there. If this rally is clearly corrective in nature, then we will probably be setting up for a major decline. My ideal target is in the 1,000 region if we see the fullness of this larger degree 4th wave. Minimally, my expectation is we get down to about 1775 to about 2,200 before the market gives us an indication on this rally as to how we take shape. So that being said, again, this is a very, very quick primer as to where I believe we are in the market. My gut expectation is I still think we get a higher high. I'm looking for confirmation over the next 2 months. If I don't get that confirmation, then we're going to be going into this longer term bear market that, like I said, minimally for the alternative count, 5 to 8 years. The fullness of it could take 13 to 21. I'm going to hand it over to Garrett. Garrett, hit stop share, and it's all yours.
Yeah, let's see here.
Share screen on the bottom.
Yep. There we go. All right, hopefully you can all see my screen now. So I'm going to start off with what I believe are some of the sectors within the S&P 500 that have the best chance, the best opportunity to see a higher high next year in that same 5th wave off of the 2020 low that Avi was showing on his charts. So we are still kind of debating whether or not that top is in place. Obviously, some individual sectors look better set up for that higher high compared to others. So to start off with, those sectors that do look best positioned for that higher high. The first being healthcare, and that I'm using the XLV, the Spider ETF, to illustrate that. It's certainly held up much better during the decline off of the highs that we saw at the beginning of the year compared to other areas of the market, and is already closer to achieving that higher high than other areas of the market as well. So if price continues to maintain above the low that was made last month, that October low, that's the pivot level that if otherwise breaks would likely mean that a top is already in place. Then a higher high here is the expectation to take price up to about 150 to 163. And to show some of the individual stocks within that sector, I'm going to do about 2 for each sector here. UNH is one of the larger holdings within XLV that looks pretty well positioned. I mean, it is already making higher highs, but does have room for further upside going into next year. Filling out a similar 5th wave, in this case, off of the low that was made in June, 1-2 in place. Within that wave 5, Avi didn't go into the difference between impulses and ending diagonal structure. It's just a different way how the subwaves within that 5-wave structure fill out. But working on the wave 3, that can take us into early 2023, and then a 4-5 into probably later into the year to complete that larger degree fifth wave and the bigger primary fifth off of the low that was made back in 2020. And we cover all of these sector ETFs and individual stocks in the Stock Wave service on our site. And we post parameters for trades on these charts called wave setups. Both XLV and UNH are active wave setups that were posted when we were turning up off of the October low. So they are stocks that we've been recommending as far as expecting that higher high and further upside. In similar situation here, price needs to maintain above that October low to keep that potential, that expectation for a higher high as the operative count. So as far as anybody trading that potential, natural stop below that October low. Another healthcare stock that does look well positioned to attempt a higher high next year is J&J. Same parameter here as far as price maintaining above the October low to see that higher high happen. And another instance where the larger degree structure, in this case going all the way back to the 2020 low, is counted as a diagonal structure. It's still overall 5-wave structure, but it's just a difference as far as how those subwaves take shape within that 5-wave move. And looking good off that October low is a smaller degree A wave within wave A of 5. So subdividing within this fifth wave is a 3-wave move rather than a 5-wave move. If you're familiar with Elliott wave theory, you know what I'm talking about. If not, don't worry about it. The expectation is still overall the same to take price up to, I would say, a minimum target of 192 in this case, but I think there's a pretty decent potential the price can get as high as 210 before that overall fifth wave ends up completing. The next sector ETF that I wanted to take a look at is ITA. This is the Aerospace and Defense ETF, which is also very close to already achieving a higher high that was made earlier this year back in April. It does look like it has seen some pretty decent progress off of the low that was made at the end of September, to the point where I wouldn't be surprised if we get some degree of consolidation before a sustained breakout to new all-time highs. Actually, not new all-time highs, because the previous high here back in 2020 hasn't yet been exceeded, but at least higher highs in the year, which means that we could see maybe a brief higher high, but I would not be surprised to see a pullback as this wave 2 of C before that more sustained breakout in wave 3 of 3 is seen. So there is an opportunity approaching if we get that near-term pullback as a wave 2 for a new entry point back, and I would say probably the 105 to $100 region would be the ideal target support, assuming that we top out within the next 5 or so points in that wave 1 of C. So some individual stocks that we have been tracking within the aerospace and defense sector. First up is RTX. Also looks like it's working on a fifth wave up from the September low. Another stock that breaks down into a larger diagonal, with price finishing up what should be wave A of A. So another opportunity for near-term pullback as wave B. And that can take it back to probably roughly 92 to about 88 in this case. So this could be another opportunity if we get that near-term pullback as the B wave to attempt an entry and use a stop underneath that September low to play for the rest of that fifth wave to the upside. And both charts need to hold above that September low to maintain that expectation for a higher high going into next year. Moving on to LMT, this is a stock that has made some pretty impressive progress off of the low that was made at the end of September. In this case, impulsive off of the July low large degree is another diagonal structure. And this was also a wave setup at the time that we had posted back in September as an opportunity based on that 1-2 filling out off of the July low. So it seems also like it's at a point where near-term consolidation, is probably getting pretty close. It, in this case, should be as a wave 4 of 3 within this impulsive C wave. And that can take it back to, I would say, roughly 454 before completing, and then turning back up for the next higher high is the wave 5 of 3, with an ideal target at about 520 for that wave 5 of 3. The industrial select sector spider ETF, another area of the market that I think has a pretty decent chance of attempting a higher high. Now there's a good amount of overlap between the holdings in XLI and ITA. A lot of those aerospace and defense stocks are in the industrial ETF here. I do have, as shown, the possibility of this being a B wave bounce, but I think there's a pretty, based on the rally that we've seen off of the October low, pretty decent chance the price is going to see a higher high here as well, where this is either wave A of 5 or wave 1 of 5. It's another opportunity for near-term consolidation as a B wave or wave 2 before a sustained breakout above the August high. Room for a little bit higher near-term first, but another situation where if we get that pullback, should provide us with a pretty decent opportunity to position for at least that C wave higher, or maybe even a third wave higher within this red wave 5. And individual stocks within the XLI ETF that are on track for higher highs. CAT has been moving up very nicely off of the low that was made back in September, is what should be a fourth wave, now filling out a fifth wave. Continues to so far fill out very nicely as an impulsive structure. Another situation where it's fairly extended at this point, it can start to see some consolidations and subdivisions as fourth and fifth waves within that large degree 5 wave move, that fifth wave off of the September low. So room for a little bit higher, maybe first in this wave 5 of 3, and then looking for 2 more sets of fourth and fifth waves, a minimum expectation of at least 1 more fourth and fifth wave subdivision to the upside. So maybe better treated as a shorter term trade setup after this wave 4 to just play for, shorter time frame move as that wave 5 of 3, but it does look like there is further subdivision higher to be seen here as price continues to fill out the rest of that wave 5. And then moving on to DE. Start with the daily chart here. So it's kind of similar to CAT. CAT has obviously made more progress, but that kind of gives DE the potential to play a little bit of catch up in comparison. Where CAT looks like it is further along in that wave 3, again, completing the wave 3 of that third, this could be still actually just trying for the initial 1-2, especially if we get a near-term move lower as this wave C of 2. If it starts to break out more immediately, then I think a little bit more nested off of that September low, but certainly seems set up for further upside so long as price is holding above the September low in this case. Next up on XLE and XOP. Energy has obviously been a bright spot in the market this year compared to a lot of other areas. It is fairly overbought at this point. The ideal scenario here is that we get a near-term move to the downside that ideally takes price back close to that September or July low in a wider flat wave 4 shown here in blue. And then once that downside has filled out, then a nice sustained rally higher as that wave 5. And the same goes for XOP. Even areas of the market that aren't quite as clearly positioned to make higher highs still can get a pretty decent sized near-term bounce. The technology sector has been one area of the market that has been beaten down the most, especially on some individual names. But it looks like at least an A wave down from the high that was made, in this case in December of last year, can easily count as complete and set up for some near-term upside and a B wave bounce, with the previous August high as a potential target to reach before completing and turning back down. And some of those individual stocks, even if not set up for a higher high, do have the potential from a percentage standpoint. The ones that got beaten down very significantly, Shop is a good example. And you saw this today as well with the large moves that we're seeing on some of these very beaten down tech stocks. On days like today, this stock was up 18%. That even if it's not heading to a new high and just getting a corrective B wave bounce has some pretty decent upside potential from a percentage standpoint. Even possible to maybe see the stock double before that B wave completes. I don't want to take up too much of Ryan's time. So how much time do you think 10 minutes is good for you, Ryan?
Yep. My turn now.
Yeah, I just didn't want to eat up too much of your time.
Got it. All right. So, hey, everyone. I'm going to start off with Bitcoin. And before I go into the chart, I want to just make kind of an anecdotal statement about, if you follow the news in crypto quite a bit, you know that the entire system really has been under stress. A lot of it's been involved, or it has involved exchanges getting into the lending market, stressing out liquidity. And then we've got a series of collapses. We had a collapse, and I've got the Bitcoin chart up. We had a series of collapses in the bottom of the wave 3, and now we've got a very large collapse in the FTX exchange that's based overseas. Fortunately, doesn't seem to apply to the FTX exchange in the US. What I want to state is we know from Elliott Wave, and following Elliott Wave counts, that often is the worst news that happens near bottoms. We don't yet know that the bottom has arrived, but in my own trading personally, I have made some of the largest sums of trading returns in times of crisis. In crypto, that involved the if you know the Ether DAO hack, which happened in, I think it was 2016, for the 2016 bottom, and which came in before the 2017 run, which has been the most massive crypto run we've seen to date. In 2018, we saw lots of miners Bitcoin miners going out of business. That helped to bring in the 2018 bottom, and then now we're seeing this kind of lending liquidation, this pressure in terms of basic liquidity of crypto exchanges, and it's possible that it marks a bottom here. If you look at my chart, actually, if you've been following along the Money Show presentations, you know that that 16,000 was a key level to me. And here, this latest crisis has brought us right into that level. And we did go a couple $100 below that level, but not enough to say that support is not held. And we have the first inkling of a potential reversal today. There isn't much to say about it yet. We've got 5 waves into the high 17Ks. I really need to see a breach over 18.3 and then hold. You've learned about the wave 2. And we need to see a wave 2 hold after that breach of 18.3. If the case, then I'll start to look towards somewhere between 25 and 30K for this parentheses 1. And that would be a very strong indication that the bottom is in. I am looking for ultimately, and I think a lot of you know from following my presentations, for this finally get that 6-figure level, and 125 level is the key level on my chart. I want to put a couple caveats on this chart long term. There is a potential that we have a running triangle form. I can see that in the chart potentially. So it may actually be that we kind of go sideways for a bit in a longer triangle, with this only being the A wave of a triangle. So I'm kind of got my base case as this impulse, but there are a few ways this can play out. Incidentally, if you follow the halving cycles, that triangle would sort of put us right into the May 23 or May 24. Sorry, I forget, where an ultimate bottom and launch into the 5th wave could happen. And halvings are basically where mining rewards are cut in half. And traditionally, there has been a bottom. I think we're actually in the place where you bottom before a halving cycle, but many months before that halving cycle comes to play, you see a lot of institutional traders position for that cut in supply, cut in inflation rate for Bitcoin. What's very interesting about our situation right now is we have a few key alts that have basically held their June lows. If you look at my chart prior, Bitcoin hit a June low, a bit of crisis showing, and now has gone lower into key support. Ether, on the other hand, has given us kind of an ugly 5-wave structure, potentially a leading diagonal. We can also call it an A wave, depending on how we want to view the move up, but has held this higher low, which I'm calling wave 2. Its move off the low today was, and again, we're talking fresh off the charts, move off the low. It looks to be 5 waves so far, and I would not want to see a wave 2 hold, and then move into this 1400 region, which is signal that the bottom is in, and that puts us on path to this 10K level on the daily chart, which is a fabulous return. I mean, what are we talking? 6.5x or 7x? I'm kind of rounding off. So that looks to be a good one. And I'm gonna go through a couple more alts that are buys in our view. One is Ave. It didn't hold an original 1-2 over the last few days, but has come down into key support in the 57 region. Don't quite have 5 waves off the low, but looks like it is looks like actually unlabeled it wrong, but this one should be a little bit to the side, and a wave 1 into the 99 level would indicate that this low is in. After an immediate degree in the 350 level, we'll get another level, wave 2, and then it should move on to the 33 region, 3300 region. So that one is quite pretty. If you're not familiar with this token, most people are familiar with Ether. This is the governance token of the Aave lending site, which is a kind of an over-collateralized, decentralized finance lending site, one that I use very actively. Doesn't get stressed because it's over-collateralized like a lot of the lending that's been being done in the centralized industry. And then lastly, Polygon, it used to be called Matic. It still holds that as a symbol, MATIC. And this one has been incredibly strong, way off of the June low, which was down here in the 30-cent region. And you can see my support level for wave 2. It's basically just touched it and dodged it. And we had a bit of a waterfall over the last few days to finish wave 2. And we're already progressing towards wave 1 of 3, which is 125, well on its way. So this we've been calling trade after trade on this one, and it's been a main holding in our service, and looks like we're getting a payoff here. So we'll get another wave 2 for an entry, which may come down to 90 cents, and then off it should go. And my key target is 10.5. Minimum actually projection wise 9.77, but the daily chart kind of has a magnet at the 10.5 level. And that is the gist. I want to say just an overall kind of conclusion on this market. I'll give you kind of some of the top altcoins that we're looking at. What's really interesting about this cycle is that we're seeing some charts that just really aren't coming together. They're probably actually headed to zero. It's just so normal in crypto for these experimental projects to try and fail. The token value kind of drops off. I've had quite a few shorts over the last year. So you have to be highly selective. And so we're kind of pulling out sort of the cream of the crop as we go along. Bitcoin is always a bellwether. Ether is always a bellwether, but we're trying to find the top charts in this as they form bottoms. I've got another, I think it's something 15 kind of watchers, but these are the ones that are pretty hot right now, along with a couple others. And that's about what I want to share. And I think we're ready for questions.
All right, thank you very much. Ryan, we did have a viewer here. They're wondering, in a hypothetical situation, if U.S. clamps down on crypto trading, even to the verge of outlawing it, would that cause a crypto collapse?
No, because the crypto market is international. I mean, it might create a waterfall, but to be frank, I don't think we have any sign that we will have a clamp down on crypto trading. There are too many banks now exposed. They're not going to want to see their asset books outlawed. We've got too many voters on both sides of the aisle. I mean, I don't remember the last data, but it was insane how many Americans are exposed to crypto. We have seen a lot of sort of spot attacks, like proof of work, Bitcoin mining, because it's quote unquote environmentally unfriendly. We may see some attempted regulation against decentralized finance. We did see an OFAC ban of Tornado Cash because some Korean hackers kind of went through it. That's now being fought in the courts, as I understand, or there is at least a brief coming to the courts. So I actually, again, I would have challenged the idea that we're going to see regulation crackdown. I think that ship has sailed with how many both banks, individuals, institutions, companies are all exposed to crypto. I mean, there would just be an uproar.
And if I can interject here, the news usually follows in with the cycles. So if it does happen, it would not shock me if it happens after the next major rally takes shape.
Yeah, that's interesting.
Could even be a bullish catalyst after recent events, as far as increased regulation being viewed as maybe bullish.
Yeah, that could be also, yeah.
All right, thank you so much. We had another few viewers here. Avi, they were wondering if you don't mind putting up that long-term chart. And the question to follow, they're wondering if this is a long-term bear market happens, how will you position during it? primarily by shorting or going long on waves up, or some mix of both?
Let me share screen. Okay. Okay. I mean, it really depends. Again, normally when you get a corrective structure, you get an A, B, C structure. It's a 3-wave pullback structure. Assuming, let's say, assume the top has been struck, and all we're going to get is a corrective move back up towards the 4,300, 4,600 region. After that happens, you would then get this A wave is comprised of an ABC structure in and of itself. Remember, fractals, variably self-similar. So an A wave comprised of an ABC structure. So this would be the A wave low. We'd be going up to a B wave high, and then we'd get a C wave down. The C wave takes shape as a 5-wave structure. And if I should get, and remember, a 5-wave structure has waves 1, 2, 3, 4, and 5. Wave 1, 3, and 5 also are 5-wave structures. So if we get a high in the 4,300 to 4,600 region, and we get a 5-wave decline from that high, that's telling me that wave 1 of the C wave has completed. We will then get a wave 2 retracement. We can short on that wave 2 retracement for the decline towards here. When we complete 5 waves down, you get out of those shorts. You then look for longs, and you probably can have a multi-year long trade in a B wave. And then once we get towards the target for that B wave, you get out of your longs, and we do it all again. You wait for a 5-wave decline, wait for a corrective retrace, and you can short again for that C wave. When this 5-wave complete, again, get out of your shorts, enter longs, and you see how this multi-year rally takes shape. Should this multi-year rally take shape as a 5-wave structure? Well, then I would be looking to wait for a corrective pullback and then add to my longs for the next major run thereafter. If it is a clearly corrective structure, you get out of your longs, you look for your initial 5-wave decline, and then again, that's where you get the market crash, where you could short for that market crash. I mean, again, there are many opportunities to make money even in a bear market. And just remember, the last real bear market that we had was 2000 to 2009. What happened from 2003 to 2007? We had a 4-year bullish rally back towards the highs. You could still have multi-year rallies even in a bear market, and we fully expect to see it.
All right, thank you so much. We had another viewer here. They're asking if the SPX is going into an extended bear market. How does Bitcoin and Ethereum behave in that environment?
Ryan, do you want to answer that, or should I just take the first crack? Did we lose Ryan?
Sorry, I was on mute.
Okay.
I'm going to first tell you how correlation goes in the crypto world. A couple of years ago, people talked about the correlation with the SPX. Then we run into 2020 or 19 to 20. We talked about correlation with the Nasdaq, and then in the last year we've talked about correlation with the DXY, actually reverse correlation. My point here is that correlation comes and goes. It gets a following for a while, and as those traders that are really requiring that correlation for their trades, they start to fail, and then people stop talking about it and they move on to the next correlation. My point is, don't correlate. There tends to be a high correlation when there's a liquidity issue. We saw that during COVID-19's onslaught, March 12, 2018. Everything was correlated to one, so to speak. If you look at the recent crisis, Bitcoin has gone down on its own. It's had its own crisis. And if you were trading Bitcoin as a leader, you would have shorted the SP 500 and would have been a big fat loser. So don't trade that way. I mean, there's nothing worse than trying to trade one chart while looking over your shoulder at another. You won't understand resistance and support on that chart itself. As you look at my chart, I'm looking for a high at 125K. There is a bear market coming after that. How much it correlates to SPX, I will not guess. I'll let Avi tell me where SPX is going. But there is a massive bear market expected after that 125K high. It may even come down to 3,000. I'm not sure it will. I also, like Avi said about the S&P 500, will see massive B wave rallies. Actually, Bitcoin has a very high tendency for B waves to actually shoot over the prior high. It's called either an expanded flat or a running flat, depending on the shape of the C wave. So we'll have opportunities even after the bear market. Again, how much it correlates to S&P 500, I don't know. I think also, lastly, Bitcoin has kind of this underlying tendency that's much like gold. It's highly rare. It's called, we call it digital rarity. If we have any kind of banking crisis, we've seen in other countries, banking crisis has caused people to run to Bitcoin as an asset. We haven't seen that in the US. Do we get any of that in a recession or depressionary type slide in the US and see a bank run? Well, Bitcoin is actually an asset people are going to want to have. And I would expect in that situation, you see a complete uncorrelation to the S&P 500. So I would just stop looking for it, because if you try to track it, you'll end up doing what a lot of traders have done over the last few years and fail. And at the same time, you'll be chasing the next correlation, looking over your shoulder at something else while you should focus on the asset itself.
All right, excellent. Thank you so much. And for this last minute or so, any final comments? We had a few viewers are wondering, is this a real rally or is it a fake out? If anyone wants to close out,
Well,
for all three of you.
As I said, much is going to depend on how the market takes shape over the next couple of months. If we get a very bullish structure, as I'm showing in yellow right now, if we get that bullish structure or some variation of it over the next couple of months, I intend to be buying back into the market in a big way, looking for a rally to 5,000 plus. If we don't get that, well, then it's clear that the next rally is going to be, this current rally that we're starting is going to be likely corrective. And instead of getting back into the market, I intend to raise the rest of the cash I intend to raise before we get another big decline.
Excellent. And Ryan, Garrett, any final thoughts?
Regarding that same question, just to add to that, sorry. Even if this is that green B wave on Avi's chart, as he shows, there's a pretty decent chance that, not in a direct line, but we can get back to that August high before completing, and then from there potentially setting up a turn back to new lows.
I was only going to add that, we haven't had a rally in crypto for, at least not in Bitcoin, and we've got really severe capitulation. And again, that's generally time to buy. I would just do it cautiously.
All right, perfect. Well, Avi, Garrett, Ryan, thank you so much for taking the time out today. Fantastic presentation. It's always a pleasure.
Thank you so much for having us.
All right, have a great evening. And everyone, thank you so much for joining us today for the first day of Money Show's virtual expo. We do have another full day for you tomorrow. So be sure to check back in with us at 10 a.m. Eastern time. Be sure to log on. You'll see more great presentations just like you saw today. Be sure to check out the virtual calendar as well that is on your screen. Go ahead and register for any of those events. You'll receive email updates on those as more scheduling holes are filled. So we'll have fantastic presenters just like you heard here today. So thanks again. We'll be back with you tomorrow. Have a great evening. Everyone be well out there.